Hi there. Today I'd like to talk to you about one of the most common questions we get asked at Reventon when it comes to finance. How can I use the equity in my home to buy an investment property without putting my home at risk? So that's a very real question that people ask all the time, and the reason for that is because so many people that have banked with, say, the Commonwealth Bank, and their parents banked with the Commonwealth Bank, so of course when it comes to buying another investment property, who else would they go to? But the same bank they've already got their mortgage through. That's actually a really big risk, and I'll show you why. Let's say, based on your income, you can buy an investment property worth $450,000. For this example, we're going to say that your own home is worth $500,000. Let's say that you've got $200,000 owing on the mortgage. That gives you $300,000 worth of equity. You can access 80% of that without paying any lender's mortgage insurance. So 500,000 by 80, 400,000. So in usable equity, we've got 200,000. So CBA, we go to the Commonwealth Bank manager and we say, I'd like to buy the investment property worth 450,000. What the CBA will do is they'll go out and they'll value your property. They won't tell you what it comes back at. They'll do the same over here, and they'll actually use this home as security. So of course, being an investment property, there are some risks. Let's say that you couldn't afford to pay the mortgage on this one. Which one do you think the bank's going to come for? The one with the greatest amount of equity. Okay, so this is a very real concern that a lot of our buyers have. It's a really simple way to fix that. I want you to take you can stay with the CBA here if you like, but I want to take this one anywhere but the CBA. You could take it to an online bank, you could take it anywhere else. And essentially what we want to do is we still want to access some of this equity, but we're going to take it out as an equity release. Okay, for this example, I'm going to use 150,000. Okay, that's now an investment loan, a tax-deductible loan. You actually don't pay any interest on that unless you use it. But you're pulling that out, and now that becomes security for this investment property, and I'll show you how that works. So we want to fund 80% of the 450 value. Okay, the reason we want to do that again is to avoid lender's mortgage insurance. So 80% of 450 is 360,000 that the bank will lend to you here, which means we have to fund the 20% plus deposit and cost. That's going to come from over here. So let's allow 90,000 to come over here. So we've got that plus some deposit and costs. We're going to have a buffer in there of about 60,000, give or take. What that's going to do is it's going to allow for those rainy days. You know, we don't have a tenant for the first month because, you know, we've just settled, there's some landscaping that's still got to be done, things like that. Rather than that coming out of your own back pocket, or, God forbid, further down the track, you have some challenges and you can't keep that investment property, you've actually built a firewall in between those two properties, which means that your home isn't security for that. You've literally got funds here to service this property. If you don't do that, it's called cross-collateralizing, and that's very, very dangerous. So this is the sort of structure we set up for our clients to ensure that you're safe. Thank you.